Howdy there, folks. Welcome into today's video. It's a buy one, get two free in this one. 3 videos for me to react to here today on the reaction channel. First one up here, bull markets don't end with this much bear market sentiment. I want to hear what this gentleman has to say. I'll react to that one, give my opinions and perspectives on that one, okay? Then we're going to listen to Professor Jeremy Siegel, and his feeling about where the Fed's going now at this point in time. He actually makes an interesting prediction about when the Fed's going to start lowering rates, which is sooner rather than later. You'll hear the exact timing and whatnot. He's going to speak about here and a few other subjects as well, so we'll react to that one. And then last one, this one I'm actually looking the most forward to reacting to, because this is actually a big subject, okay, and this actually does affect the economy in a very substantial way. Credit tightening will impact small businesses, lease renewals, okay? And if you know anything about the U.S. economy, the U.S. economy always has and always will be run and prosper when small businesses are doing well, and it will falter when small businesses are going out of business and when they're doing very bad. So it's a very important subject, and so that's why I wanted to. It's not the most flashy subject, but I can tell you that that might be the most vital video we react to in this one. So appreciate everybody joining me as always. Thanks for being subscribed, folks. 26,000. And I don't know, we might be at 26,600 plus subscribers now, so I appreciate y'all. If you're looking to join my private group, check out the description area. Let's get into this.
People's Barry Bannister to talk about the note and the view. Barry, good to have you back.
Thank you.
So we've had all these recession calls get pushed out or pushed back at least the last few quarters. It sounds like you think the time to worry just isn't quite here yet.
No, I don't. There's an awful lot of bearish sentiment out there, and bull markets, even strong rallies, don't end with this many bears. And I know the generals, the tech generals have been leading, but markets can stay narrow longer than shorts can stay solvent. So I like what I'm seeing on the economic growth. I watch all the data. And in the note we did today, we narrowed it down to just those few variables, like financial conditions index, that we have to monitor all the inputs to and what we see happening with those, because that's going to drive the target price.
That said, the timeline of your target here, and it is relatively short term, does coincide with what could be real dysfunction in Washington. I mean, how much of the model is that right now?
Well, it is hard to model the politics side. I mean, we do a lot of political analysis, and
this gentleman believes the S&P 500 is going to 4,400, but that's by midpoint 2023. So think about this for a moment. That's in like 2 months, okay? That's in 2 months. So basically, he's expecting the S&P 500 here to blast higher over this next 60 days, roughly, okay? And you could take it less days if you're just adding up, obviously, trading days in there, okay? That's what this man's expecting. So that's a bold, big prediction there. I mean, that's yeah, it will be a lot of fun in the market over the next 60 days if that does transpire.
Helped us understand why Powell turned hawkish 6 days after he was reappointed November 22nd of 2021 after doing QE over a year too long. Coincidence? So when we look at what's been done, the market has a little bit of PTSD. It's thinking about 2008. Some people like me can go back to the savings and loans or the early 80s energy banks. But I think it's relatively contained and short-lived. I think the issue really, as far as getting ahead of this, is that by the end of this year, I think employment will be weakening enough that I would be concerned about that late cycle indicator dragging down the coincident indicators like consumer confidence and where they feel right now, not the expectations, but the current feelings. And when that happens, then it'll be over. I think we'll have a significant slowdown.
Interesting. Okay. So it sounds like he's a little more bearish longer term and very, very bullish on the very short term, right? Which are interesting things. It's definitely more of a trading mentality there in regards to that. We'll see what happens. I don't have too much more to add than that. I mean, predicting where the stock market's going to go over the next 45 to 60 days is it's a tough business. It's not a business I'm interested in being in nonetheless, folks. Okay. Here's why Wharton's Jeremy Siegel thinks the bar is extremely high for another rate hike plus a lot more.
Monthly employment report showing a stronger than expected increase in non-farm payrolls for the month of April. The unemployment rate dipping to 3.4%. The strength of the report causing some speculation that the Fed could keep raising rates for longer. But our next guest says the Fed is done raising and the bar is high for it to continue. Let's bring in Jeremy Siegel, Professor Emeritus at Finance University of Pennsylvania's Wharton School of Business. Good to see you again, Professor. There were some revisions from previous months, so it was stronger than expected, but definitely we've seen the average come down to where it's not running nearly as hot as it had been. So maybe that's why we saw the markets react that way. The Fed wants to, at least the body language, they want a position that they still might raise. And I understand that. You probably understand it too, but you don't think they will.
Right. I think the bar is extremely high. I mean, let me tell you what I think has to happen. On Wednesday, we get a CPI. It has to be much hotter than expected. And I don't mean just 1/10. I mean, 2-3 hotter. We need a very hot employment report for the month of May. And then on the first day of that June meeting, we get another CPI, and that has to be much hotter. If those three things happen, which I think are way out of certainly extremely low probability, I mean, not impossible, then I think another quarter point might be on the table. But look at all the uncertainties with the debt.
Yeah, in terms of CPI, so from my understanding, CPI expectations for what's about to come out here in the next less than 48 hours from now, it is the expectations like something with a very high 4 in front of it, from my understanding, from most folks out there. I believe we could definitely come in with a mid 4 and potentially even a low 4. So, maybe I'm a little too optimistic on that, but I look at the truflation numbers. If you look at truflation numbers throughout the month of April, we were either mid 4 or low 4s the entire month of April. So, and we did, I think, I recall the truflation numbers did hit some 3s here and there throughout the month. So nonetheless, folks, I think that's impactful. We'll see if obviously it plays out, and truflation numbers aren't always exact. The truflation numbers had us at much higher CPI numbers than the Fed ever had us at, or the government ever had us at. They actually had last year us at like 11 and 12% when the government was reporting like 8 and 9% numbers. So do keep that in mind. But then you can also look at it and say, well, if they're usually too high when it comes to truflation numbers, maybe they're too high right now. And so if truflation was showing like a 4.3 throughout the month, maybe it's lower. I don't know. Okay. But nonetheless, I'm pretty confident we're going to be something with like a mid 4 in front of it. It sounds pretty realistic to me.
I mean, you guys have been talking about it. It is amazing that, the Treasury bills, which are considered the safest in the world, that, 1 month Treasury bills are 5.5% or more above the Fed funds rate, which is, between 5 and 5.25. That is a very rare situation. Is that going to be resolved by June? And even if they kick it down the road, probably with an extension, that won't be resolved for a period of time. I think the body language, and I think you're right. I mean, Powell was saying that I'm going to let the forces of the cumulative rise in rates, which is 500 basis points, the tightening that we know is coming because of what's going on in central banks. There's not going to be a banking crisis. I'm not worried about that and a deposit flight and all that. I'm worried about tightening of lending standards. That's something that is certainly going to take hold. And I think he's content to let that play itself out and see if that does.
So tightening of lending standards, there's two ways to look at this, folks, okay? The first way to look at that is, oh man, that could hurt us short term. The other way to look at that, okay, is that's an extremely healthy thing for the long term. And that sets you up for a 5-10 year runway of prospering. Okay, when lending standards are tighter. Coming out of the great financial crisis, lending standards were very tight. It was not easy to get a loan, and ask anybody who was trying to get loans on different things in 2009, 2010, 2011. It was tight back then, right? It was difficult. As somebody that was coming up in the financial system throughout that time, I experienced that firsthand. And even like what I had to pay the first time I got a car, in terms of an interest rate on that, like I experienced all that. And so we've been, I would call it more on the loose side when it comes to lending standards for a bit here. And I think it would be extremely healthy for the long term if we remain tight. When it comes, it hurts short term, absolutely, it hurts growth. If that person that was going to get that car loan doesn't quite get that car loan, or going to get that house or whatever it is, okay, or get that extra credit card limit, whatever, Hurts in the short term, but I'm telling you, it sets you up for a lot healthier long term, folks, okay? And so that's what you have to ask yourself. Is the short term gain worth the long term pain? Wait, no, the other way around.
To keep slowing the rate of inflation. By the way, one other thing I thought was very interesting. He said, and he said it twice, that he didn't think that wage increases were the principal cause of inflation. And remember, that's something that he had focused on before. I thought that was an interesting statement. Now, that's something that I believe in. I think that it's wrong to suppress wages, which have fallen behind inflation going forward. But he did make that remark twice in the press conference that followed. So that body language, that statement, the bar is extremely high. So I think, 500 basis points, nice round number, right? 5 percentage points.
Yeah.
I think they're going to wait a long time and actually start reducing rates later.
It's been a big move. So we are here. So you think in the face of what we're seeing with yields, I mean, the market's completely different than where the Fed is. And that we keep having that argument, who's right, the Fed or the markets. So they're going to stay at 5. Do you think they're going to stay there for a while, even though the bond market is saying you're too high? Or do you think that something happens where they cut sooner than they're planning to?
Well, here's the bar for them to lower rates. You got to have a negative payroll. You got to have a negative payroll. I mean, then 1 or 2 negative payrolls. Don't forget, we're getting in a political season where everyone's talking about primaries and, if we get a negative payroll, that's going to hit headlines. And the polls have not been great for Biden in terms of his handling of the economy. All you need is a couple of negative payrolls and rises in unemployment rate and the political pressure on the Fed to say, hey, guys, isn't it time to maybe start notching down that Fed funds rate, even if you haven't killed the last vestige of inflation, something that would be needed. And in fact, if you do see a faltering of the real economy and lowering of that rate, I don't think inflationary pressures are going to be a major concern for the Fed. So you can have to see negative payrolls. It's not impossible, certainly. That's when the talk will begin on maybe lowering rates. And, 2 or 3 of those combined. And I think by the fall, we might actually see them notch down rates.
Wow. By the fall, notch down rates. So I agree with a lot of what he said there in his even prediction about the Fed lowering rates by the fall. That goes with my conspiracy theory I have, which is at some point this summer, the market's going to force the Fed's hand here, okay? And so I do agree with him. A lot of it goes back to politics in terms of pressure. And we've already seen, certainly on the Dem side, them already putting pressure, Elizabeth Warren and a few others, putting pressure for the Fed to lower rates faster. So this is one I'm really looking forward to. Mr. Short Hills Capital, Steve Weiss, talking about credit tightening, but specifically in regards to small businesses, lease renewals, and other subjects.
Yeah, we got more earnings like Disney, debt ceiling meeting. Janet Yellen's on later today. She's already said if they don't raise the debt ceiling, quote, we'll have an economic and financial catastrophe. Austin Goolsbee today is getting vibes. Those are his words, that a credit squeeze is beginning. And yet, I don't know, we're kind of hanging in. What do you think?
Yep. Well, I think there's a lot of vibes out there that haven't proven to be anything in the data yet, but it's a huge week for inflation. Remember, CPI is what the consumer pays. PPI is what businesses are paying. So we're going to get a read on both. If we see CPI stay flat this month, I think that's probably not a great sign. PPI may come in a little bit weaker, but that's, to me, an indication that businesses are assuming activity is going to be slower going forward. So again, not a great sign. I've waited for a while for weeks like this to come about and to actually move the market in one way or another. I don't know that we're going to get a week like that yet. I think that, yes, we have some earnings still left over. I don't know that they're going to be that influential on the direction of the market. We've gotten the bulk of earnings season, and largely the narrative has been not as bad as we expected. So we're still afloat. We've stayed buoyed by that. But I do expect that this credit crunch and the contraction in availability of funds is going to really start eating into small and mid-sized businesses, and we're going to hear about that soon enough.
All right, so Joe, we got the debt ceiling issue. We got a central banker talking about a credit squeeze beginning, and the VIX is at 17. And I'm wondering what you think of after last week, which was a big week, as we head in now with sort of everything on the table. Market's too complacent or not? Where do you think we're going?
I think the market is incredibly resilient. I told you last week, I thought there was a change in trend when we failed up at 41.86. Next thing we know, we're trading at 40.48. Last Wednesday, here we are back to 41.50. That's a very resilient market. Now, a lot of that was Apple's earnings acting as a catalyst, mega caps continuing to be strong in the marketplace, but you can't dismiss the premise of the resiliency. But overall, we are clearly in a consolidation range. We're waiting for a lot of information, which Liz has, pointed out. I think when you look at inflation this week, you have to understand it's going to be distorted because the price of gasoline was up 3% in April on the back of the OPEC supply announcements, and that's been reversed here in the month of May. So I agree with you. I'm not necessarily sure you get an indication on overall where the market's going to go. I still think what you're trying to do here is you're trying to mine for opportunities going bottoms up within the market and see if you could capture some alpha in that regard.
Yeah, so, I mean, obviously, you hear a lot of these Wall Streeters are talking about, basically kind of waiting around. They're waiting around for clear signals on, where the market's going, right? And they're waiting and they're waiting and they're waiting until we finally get whatever that is, right? As an individual investor, I don't think that's the right mentality to have. You see opportunities in the market, you got to take advantage of those opportunities. You can always take advantage of more opportunities if more opportunities present themselves, right? But these Wall Streeters, they play the game so scared, and that's why they can't even keep up with the market, to be quite honest. Like, look at most of the Wall Streeters. They can't even keep up with the market in terms of market returns because they're playing in such a wait and see approach. You're not a professional if you need to wait and see. That's the bottom line. Think about it, right? Imagine if this is sports, for instance, right? And imagine Tom Brady's like back there getting ready to pass, but he's like, I got to wait for all the guys to get. You can't do that. You're going to get sacked, okay? Imagine it's an NBA player, and he's like, I'm going to wait until see everything, and then I'll shoot the ball. The shot clock's going to run out by that time, right? You can't wait forever and ever and ever. At the end of the day, you've got to take action. You've got to go to where you think things are going and why you think things are going there. Because at the end of the day, the market's going to give a lot of the false flags, I guess we can call it, where it's going to, or a lot of magic tricks where it's going to have you believing something over here, the market's going to crash, or the market's now in skyrocket mode or whatever, and then it does the opposite thing. So it's almost, in my opinion, it's not even a game worth playing. It's not even a game worth playing. Like, focus on your game, focus on, where the puck's going, as Wayne Gretzky said, right? If you ever played quarterback, you got to throw the ball to where the receiver is going to be, not where he's at right now, right? Because he's right there. You need to throw it way out there, right? And so that's the same approach in the market. And, whenever I hear these folks, waiting for confirmation from the market, what does it need to do? Go up another 15% and then you say go in for then it to drop 25%? Like, you know what I mean? It's a silly game, man. You're not a professional if you need all these confirmations and the market to hold your little hand and tell you exactly where you need to go. You're just not a professional, in my opinion.
You sort of look for your opportunities in the rebalance of the Joe T in terms of adding, more growth, mega cap tech, et cetera, reducing some cyclical exposure. All right, Weiss, Barry Bannister, Stifel, I referenced one strategist at the top here raises the target. He goes to 4,400 from 4,200. He talks about the resiliency in not necessarily the market per se, but in the economy. We also forecast inflation, he says, to slow sharply. Mike Wilson
Wasn't that the guy we talked about at the beginning? Yeah, the Bannister guy. Okay, interesting.
There's that. Many of the leading macro data points have fallen more recently and are not pointing to a similar run rate in terms of EPS strength looking forward through year end. So Bannister grows more optimistic. Wilson stays, cautious as he's been. Mm-hmm. What about you? We've been under
cautious. Please don't let Mike Wilson save face. That man's been one of the most bearish, if not the most bearish bear on Wall Street. Okay, don't let him save face. Cautious baloney. The man's been calling for the market crash for as long as I can remember now at this point in time. Come on, man.
Resilient, I think, right? From not only an economic standpoint, but I think even you would admit, the market's kind of hung in the face of a lot.
The market wants to go higher. To me, this is, I'm sure one of Liz's favorite shows when she was growing up was Hogan's Heroes. They had a character, Sergeant Schultz. So this is a Sergeant Schultz market. I see nothing, I hear nothing. Let's just be happy and go along. And that's what's going on. So the market has this resiliency, not across the market. You take a look at Boeing, for example, trading below 200 again. It got up to 225 or so. So it's really pick your spot. Friday I found bizarre because you had inflation picking up in terms of wage inflation, and that's 2 days after Powell said, hey, I'm not just looking at wage inflation, but that moved up. You had the bond market yields really rocketed up, yet Apple controlled. So you're sort of picking what you want to look at, and what people are looking at are tech earnings to justify the market. Could that be the right thing? Could be. Now, the way I'm dealing with it is normally in this kind of environment, I'd be short some things, but this is not a market where you can be short because you get your face ripped off. So I choose to have lower exposure. Austin Goolsbee, I agree with him. And I think the issue with commercial banks, the regional banks in particular, that they haven't seen this massive walkway like we saw with Blackstone and others is because leases just haven't come due yet for renewal. So you're not going to walk away from a lease right now because you're going to get sued, and guess what? You're going to have to pay. So as you see that go through the system, as you see credit tightening, and he's right, it is tightening, that's going to impact the small businesses, which is why we're seeing the Russell not do as well as top line tech.
Yeah, that's a good point there, but I want to touch on something.
You had inflation picking up in terms of wage.
So he speaks about wages right there, right? And, okay, so you need to ultimately see wages going up over time, okay? You can't have wages going up too much, or it leads to, obviously, bad inflation. But at the end of the day, like, let's not confuse this. Wages going up is a good thing. If wages go up too much, that's a bad thing, okay? But you do need wages to go up over time. And you ultimately need wages to outstrip people's expenses, right? And some folks refer to that as real wages, right? Which real wages have been in a really bad spot for 2 years now at this point in time, okay? So you can look at these things as only negative. Oh, wages going up. That's not, almost always that's not a bad thing unless it's out of control, okay? And I don't know if the wage growth was really out of control. I couldn't say that, okay? But the bottom line is you want consumers to make more money over time. Like, would you rather have everybody make $15 an hour for the next, 10 years? Let's say on average, $15 an hour or whatever, $20, let's say $20 an hour. Everybody makes $20 an hour on average for the next 10 years. While everything else goes up in price 1-2% a year? Of course not, right? That's not a situation. You'd rather have a situation where, let's say, wages are going up by, let's say 3% on average a year, 4% on average a year, and you got inflation in the 2 to 3% range, right? That's an ideal situation because you got wages just a little outstripping the rate of inflation overall each and every year. That's perfect scenario, okay, folks? So I thought it was worth addressing, okay? I appreciate everybody joining me as always. Much love, folks. If you're looking to level up your investing game and understand how to run money the best way possible, check out the description area. That'll be to apply to join my private stock group and get all the knowledge I have up here, access all my different courses, all my curriculums, the Discord chat, get access to all that. Appreciate y'all. Much love as always, and have a great day.